Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. As always, we're going to run through some of the most important charts and themes that are going on today. If you're watching this on YouTube, hit that subscribe button. Here's a look at some of the topics we're going to discuss. Equity markets, all news has been good news. Another strong earnings season for the S&P 500. Home Depot stock going up despite earnings going down in terms of the growth rate. Higher home prices in the U.S. and lower affordability. That continues to be the main story there. Higher incomes in the U.S. driving the economic expansion. Bond bear market continuing. So another month of a drawdown for the bond market. So very different than the stock market. Federal Reserve now not expected to cut interest rates until June. So we'll talk about market expectations there. Big shift from where we started the year. And we'll end with something positive as we always do. And that is the rental market. More affordable rents. So let's dig in and start with all news is good news. So whether it's good economic data, bad economic data, the market seems to be receiving it in one way, and that is positively. The S&P 500, another up week, ending the week at another all-time high. It's now been up 16 out of the last 18 weeks. So you remember that correction we had back last October? Well, look at the rally we've had since then, up 16 out of the last 18 weeks. We hit that all-time high and just continue to surge from there. Just an incredible run. That hasn't happened this 16 out of 18 weeks. I went and looked. It hasn't happened since 1971. So pretty long time between periods where the S&P 500 has been up this strong in an 18-week period. And if we look at the number of all-time highs, as we said, when we hit the first one back in January, all-time highs are not a signal of anything. You tend to see more all-time highs following all-time highs until the peak in a bull market. Of course, no one knows when that will be, but what we know so far is that the market has hit 15 of them now this year. And if that were to continue at this pace, which is unlikely, just to give you an idea of how many all-time highs this is in a short period of time, it would exceed the record from 1995. 1995 is kind of the gold standard in terms of a year with a very little drawdown. I think the biggest drawdown was less than 3% the entire year and almost hitting a all-time high every single week that year. So far, very strong start for the S&P 500. If we look at what I call the enormous 8 stocks here, Nvidia and Meta leading the way again. Nvidia already up 66%. It's only March 1st on the year. So best performing stock in the S&P 500 last year, and once again leading the year so far in 2024. Meta up 42%, Netflix outperforming, Amazon outperforming, Microsoft outperforming. But interesting here, you have Google, Apple, and Tesla underperforming this year, all down on the year. So a little bit of differentiation there. Remember last year in 2023, all of these members outperformed the S&P 500 and did so by a wide margin. So if we look in terms of sentiment, this is one way to gauge it here, looking at credit spreads. This is the spread between high yield bonds in the top chart here and investment grade bonds, and looking at the spread between them and risk-free treasury securities. And you can see here, spreads are tightening. So when the spread goes down, less fear in the market, people are pricing in less risk of default. And now we have the tightest high yield spreads since January 2022 at 3.22%. Tightest investment grade spread since November 2021, 0.93%. The investment grade spread number not too far from an all-time low. High yield spreads getting there in terms of tightness. Still would have a little ways to go in terms of all-time lows, but as you can see here, it's very difficult to say. This can continue, obviously, for a number of years being tight, but what we can clearly say is sentiment has shifts. There isn't a lot of fear built into the credit markets right now with these tight credit spreads. And looking at the year-to-date performance through February, pretty good in terms of equities, in terms of crypto, obviously, in terms of growth stocks, a lot of continuation from last year. The difference here so far through February would be the fixed income side down on the year. If we look at EM bonds, US bonds, long duration US bonds, all down on the year so far. And in addition to that, REITs as well. So interest rates moving a little bit higher this year, so hurting the bond market, but obviously a long way to go. And we'll talk about bonds a little bit later in the segment, but clear leadership this year in the riskiest growth areas of the market: NASDAQ 100, US growth stocks, and cryptocurrencies with Bitcoin. Speaking of Bitcoin, up almost 50% on the year. And we have these new Bitcoin ETFs obviously approved, and money is just really starting to surge in. We saw this last week with this huge surge, 95.8 million in terms of this one Bitcoin ETF shares traded. That was 126 more than the prior volume high. So when you tend to see this spike in volume in terms of huge spikes, it tends to be an indicator that sentiment is getting euphoric. So we'll see. We'll take a look at this next week to see if this was some type of sign here. But clearly, retail investors starting to jump into this asset class, getting excited, not just in terms of growth stocks, and we've talked about Nvidia, obviously, and Magnificent Seven, but this sentiment picture is now transferring definitely into Bitcoin, with Bitcoin rushing up to over 60,000, coming within spitting distance of its previous all-time high. So let's talk about the big driver of the equity markets over the past year, and it's definitely been earnings. So fundamentals have improved. That's been the primary driver. Yes, there's been multiple expansion as well, so we can't discount that. But definitely the number one reason, if we'd say why have stocks recovered, it would be that earnings have recovered. And if we look at S&P 500 operating earnings per share here, we're at now a new all-time high, exceeding the previous high from a few years ago. So fundamentally, market is back at all-time highs, and now it's just a question of what investors are paying for it. And yes, they are paying a higher multiple than the average multiple over the past 30 years. And that has some investors concerned. But if we look at the growth rates here, as long as this continues, I think sentiment stays strong. So what do we have? 97% of companies reported here, 22% year-over-year increase in terms of GAAP earnings per share. That was the fourth consecutive quarter of positive earnings growth. And remember that earnings recession we had back in 2022? Well, we've erased that now, again, being back at all-time highs in terms of earnings. Now, in terms of sales, seeing a little bit of a slowdown here, 4.6% over the past year. So you can see here just that huge surge in sales coming out of the COVID period, and obviously that huge stimulus driving sales just higher in terms of retail sales, but corporate sales in general. And now we've just seen this gradually mean reverting back down here, now 4.6% over the past year. But if we compare it to the inflation rate, it actually exceeded it once again. So we now have a few years now of consecutive quarters where sales per share have outpaced inflation. So just looking at US CPI. So this is a positive sign. As you can see here, during real earnings downturns, you tend to see this real sales growth turn negative, and you definitely see that during recessions. We saw that in 2001, 2008 recession, and during the COVID 2020 recession. So interesting thing about earnings, obviously, is not just the news that matters, but the reaction to the news. And Home Depot, just unbelievable in terms of the resiliency here, given what's going on in the fundamentals there. So we got revenue for Home Depot down 3% year over year. That was the fourth straight quarter of negative year over year growth. But if you look at the stock price, as I'll show you in a little bit, you wouldn't know this at all. But first, let's take a look at net income, even worse than revenue, down 17% over the past year. I look back, that was the biggest year-over-year decline in net income since 2009. Now, is the stock doing anything like it was doing back then? Absolutely not. Look at Home Depot here, up actually 33% over the past year, outpacing the S&P 500 despite this earnings decline. So market clearly saying this is a short-term thing. They're looking ahead to better earnings, obviously ahead for Home Depot. We'll see whether that expectation is right or wrong, but just shows you the resiliency, even for a company like Home Depot that's struggling in terms of the fundamentals. The stock market doesn't seem to care whatsoever. So let's switch gears here, talk about the housing market. This has become what I call the Groundhog Day market. If you've watched that movie with Bill Murray, it's the same thing pretty much every day in the housing market, which is home prices are going up, affordability staying down. And if we look at the Case-Shiller Index, we got the final reading for December, another all-time high. Affordability here in the red remains very low. And if we look at the 20-city index, up 6.2% over the last year, another record high ended the year. And if we look at all 20 cities in the index now are positive year over year. That's the first time we've seen that since 2022. And so we have a really rising tide once again. So the same situation that's going on in San Diego is going on in New York, is going on in Tampa. What we're seeing is very low inventory. And even though demand has gone down because of a lack of affordability, well, supply has gone down even more, and that's pushed up home prices. So what that means is if we look at the median asking price of a home for sale, looking at Redfin data here, we actually have the increase here of 5.5% over the last year. It's almost a record high in terms of asking prices. And there's seasonality to this. You tend to see prices go up into the summer. So the expectation is this will actually continue, and we'll see a record high in terms of asking prices for homes for sale. And the only reprieve, I would say, is the fact that we're seeing a little bit increase in terms of new listing inventory. It's actually higher than last year. Last year was obviously a record low, so that's not saying too much, but at least we're seeing a little increase here. The best thing that could happen for the housing market, obviously, more supply. And why is that? Because the affordability picture just remains so low. And we see that here in terms of the median home buyer housing payment you would need. So your mortgage payment you would need to afford that median home price for sale. And it's $2,671. You can see just a few years ago in 2021 where it was way lower. And what's driving this? Well, two factors: the huge increase in home prices and the huge increase in mortgage rates. And with mortgage rates now at their highest levels of the year, that's not helping affordability whatsoever. So we want to see more supply in the housing market. That was predicted. People were also predicting that the mortgage rate would come down. So far, that hasn't happened this year. It's actually been trending back up, getting closer to 7% again. But we'll see. A lot of year to go. We still have the Fed that might cut interest rates. That might help. So we'll talk about the Fed in a little bit. But let's take a big picture look here. We have final 2023 data. Housing prices in the U.S., another up year. That was the 12th consecutive up year in terms of nominal prices. Real home prices, so adjusting for inflation, up 2% last year, got back into positive territory after a little bit of a decline in 2022. But as you can see here, just an enormous run over the last 12 years and far above what we've seen in history. So going back to 1891, average increase in home prices, 3.4%, only a 0.5% higher than the average inflation rate. So what we've seen the past decade plus, very unusual in terms of home prices far exceeding inflation. And this chart really illustrates that. We're now 120% above inflation. Never been this high before to end a year, higher even than where we were during the last housing bubble. So very likely next 10 years, your expectations for housing prices should not be nearly as optimistic as the last 10. This tends to mean revert because home prices in the long run tend to be based on people's incomes. And if home prices are unaffordable, all prices have to adjust to that. So we're likely in for a period where real home price appreciation, so home prices compared to inflation, is not likely to increase the way we saw during the last decade. And particularly in 2020 and 2021, you see 9% outpacing inflation and 12% outpacing inflation in 2020 and 2021. Just ridiculous moves higher, driven in large part by the Fed keeping interest rates low, buying mortgage bonds. So really pushing up home prices, pulling forward, I would say, these real returns. So we'll see what happens here, but keep your expectations in check for the housing market. This is definitely abnormal behavior in the last decade. But in the short run, all that matters is the supply and demand. And as long as supply remains very low, it's very hard for prices to come down. So let's talk about what's driving the economic expansion. And that would be number one, higher incomes. And we have updated real GDP data for the fourth quarter, 3.1% year over year. So strong and accelerating growth. What's the expectation for the first quarter? With Atlanta Fed puts out this real GDP now predictive model here, and they're right around 2%. It started out higher. This tends to happen. It tends to trend lower as the quarter goes on, but we're only in the beginning of March here. We still have a lot of data in March for this model to adjust to. And what is Wall Street expecting? They're right around 2% as well. So the expectation for the first quarter seems to be moving back towards that kind of 2% longer term trend. We'll see what happens there. But what's driving that continued economic growth? In my mind, number one would have to be the fact that real incomes in the US continue to go up, even adjusted for inflation. So this is showing you real personal income, excluding transfer payments, so excluding the stimulus and other programs from the government. They're at an all-time high and up 2.9% year over year, so outpacing inflation by 2.9% year over year, and 9 consecutive months at an all-time high. And during recessions, you don't tend to see this upward trend. You tend to see sideways to downward action during recessions in terms of real personal income. We're simply not seeing that today. Bond bear market. We got to discuss this. It continues. The stock market, as we've been showing, is hitting all-time highs almost every day. Bond market, not so much. Still in a drawdown. This is now by far the longest bond market drawdown in history. 43 months and counting. It started in August 2020 when the 10-year yield was about 50 basis points. And today, 10-year obviously above 4%. And at one point, we had a max drawdown of 17%. Where are we today? We're around 11% as of the end of February. So, which means this drawdown is likely to continue. And looking at, let's say, 4% a year, it would take still a few more years to get there. But what would cause this to get back to new highs before that point? Well, obviously, a decline in interest rates. Bond prices move in a different direction to interest rates. So if interest rates fall aggressively from here, we could get back to new highs before a few years. And what would be the number one thing that might drive that? Well, the Federal Reserve and cutting interest rates. But here, this is the good news for long-term bond investors. We started out in this bond bear market at the worst position in history for the bond market. Again, below 1% in terms of the 10-year Treasury yield. That predicted below 1% long-term returns. And now we've moved up to the third decile here. Last year, briefly, we got up to the fourth decile with the 10-year moving up to close to 5%. But today, we're about 4.2% on the 10-year. And the next 7 years for bond returns should definitely be better than the last 7 because there's a 97% correlation between starting yield and forward bond returns. So what happens in the short run is going to be entirely driven by the direction of interest rates, whether they go up or down. But what happens in the long run is highly dependent on that starting yield and much better placed today than where we were a few years ago. Now, the Federal Reserve is going to have definitely have an impact on short-term movements in the bond market. And here I'm showing you U.S. bond market performance during major rate cuts going back to 1980. So these are different rate cut cycles. And you can see here, Fed funds rate is being cut. Here's what the Bloomberg Ag bond index doing. And here's what their annualized return is during this period where the Fed is cutting interest rates. And you can see pretty strong returns across the board when the Fed is cutting interest rates. So speaking of the Fed, what are the current expectations? Well, they've been pushed back. Remember, when we started the year, the expectation was for the Fed to start cutting in March. So just in a few weeks from now, the Fed was expected to start cutting interest rates. That's not going to happen anymore. We have a number of new data points suggesting inflation rates are moving lower, but not moving lower enough for the Fed to start cutting just yet. Now, here's very good data point, in my view, number one data point that you want to continue to see in order to say inflation will continue to trend lower and stay lower. That would be the money supply, the thing the Fed never talks about. So 2020, 2021, money supply is going up 40% over that 2-year period, by far the biggest increase in history. The good news is the Fed got the message, and the money supply has actually contracted 3.6% over the last 2 years. So we've never seen that type of contraction before. We have data going back to 1960. And what this means is for inflation is the expectation should be lower. And in terms of those expectations, U.S. consumers are predicting exactly that. These are a survey that the New York Fed does every single month. And this is their recent 3-year ahead expectation, 2.35% per year. That's the lowest on record. So what are consumers expecting going forward? Lower inflation rates. That's good news because part of the inflation picture is those expectations. If you're expecting inflation to be high, you're more likely to tolerate higher prices. You're more likely to say, oh, it's only a few percent increase, I'll pay it. But if you're expecting it to be lower, you're going to give it more of a fight. So the actual hard data is showing a continued decline. We have PCE price index data here, 2.4%. That's the lowest since February 2021. And the core PCE, which is the Fed's preferred measure of inflation, down to 2.85%. That's the lowest since March 2021. So not quite there yet, right? The Fed wants 2%, but trending in the right direction. And if we look at the spread between the Fed funds rate and core PCE, this is how you tell if monetary policy is tight or it's easy. And you can see here the spread here, pretty wide. It's actually the widest spread that we've seen at 2.4% since September 2007. So you have to go back a long time to find a period where the Fed was this restrictive. And so this is what a lot of people are pointing to, saying, well, they can cut. They have room to cut. Now, this is where I have a different opinion. My view is that let inflation actually moderate some more. There's no urgency to cut. We could see that with stock prices at highs, home prices at highs, all of this other data. Economy is expanding, unemployment rate is low. So continue to focus on inflation. That's my argument. But what other people are saying, well, this is too tight. The Fed's risking a policy mistake and they should start getting to work. But regardless, the market has changed its view. It came into the year expecting 6 to 7 rate cuts. Now the market is kind of in line with what the Fed projected entering the year, which was 3 rate cuts. And the first one now that the market's expecting is not until June. So a lot can change between now and June. We always say, take this chart with a grain of salt. It's likely to change. It's already changed a ton since the beginning of the year. Remember, it was saying 6 to 7 cuts, now only saying 3. But all of this is not written in stone. It matters what happens if inflation data starts to move back up. Well, perhaps they'll only cut one time this year or no times this year. If inflation comes down quicker than this, or we see real economic weakness, perhaps the Fed will cut more than 3 times. So all of this, as the Fed likes to say, is definitely data dependent. But for now, the way the market is interpreting this is we have a Goldilocks scenario where the economy is still expanding, inflation is coming down, but we didn't need to have a recession to cause a rate cut. It's a Goldilocks scenario like we saw in 2019, where the Fed was cutting rates and we weren't in a recession. So that's the view today. What would change that view? Obviously, weaker economic data, higher inflation. Those would be the downside risks. But for now, all news is good news in terms of the market's interpretation. So I want to end with something positive, as I always do. This is the most positive thing I can think of today, which is more affordable rents. And I know what you're thinking. You're probably saying rents went up so much. It's not it's not helpful that they're only down 1% year over year. Yes, I could agree with you. But the fact is they are down 1% year over year, and wages are going up more than that. And if we look at the cumulative increase since 2021, we actually seen now wages go up a little bit more than asking rents. And so that spread between wages and the increase in rents is leading to much more affordable rent picture. It's the exact opposite in terms of the housing market, where housing prices have far exceeded wages and they're still hitting new highs. If you see, rents here peaked in 2022 and we're still below that today, but incomes continue to go up month after month. So we have 22% increase in income and hourly earnings since the beginning of 2020, and rents up 19%. So that spread, very good news if you're looking for an apartment to rent. If you have an existing apartment, yes, you're not likely to cut that rent. Maybe, 1% is not a huge amount anyway, but for people that are looking for a new apartment, there's more supply. So it's a different situation than the housing market. There's a lot of construction in the past few years in terms of new apartment buildings, multifamily buildings, and what we're seeing is that translate into higher supply and higher vacancy. So 6.6%, highest vacancy we've seen since 2020. And this likely should continue to lead to more good news in terms of asking rents. And as long as wages go up more than rents, well, that's going to lead to a more affordable picture, and very good news for anyone that's looking for an apartment. All right, with that, we'll end it right there. Have a great weekend, everyone, and I'll see you next time on the Week in Charts.